Hello everyone, let's do a review exercise for Chapter 14. And in Chapter 14 we're going to be calculating variances, but different variances that we calculated previously in the semester. This time we're going to be looking basically at our sales variances. So we're going to be looking at our numbers and figure out what portion of the difference between the margin we expected to have and we actually had can be attributed to things like the number of units that we sold, the mix of our different products that we sold. Did we sell enough of our most profitable products? And our portion of the market share. Did we capture as much of the market as we thought we were going to? So for this example, we're going to have a company called MC Incorporated, and they sell fruit drinks. They have two different brands. To keep it simple, we'll keep the information small. They are the Costor and the Limba. And in this chart, we have the budgeted and actual information for these products: selling price, the variable cost or cost to produce each carton of these fruit drinks, and the number of cartons they expected to sell and actually sold. So we can use this information to start calculating our variances. But before we get there, the first thing we got to start with is figuring out what our total contribution margin was budgeted to be. So for the Costor, we're going to grab all of this information from the budgeted section. We budgeted that this particular product line was going to sell at $12 a piece. And for the Limba, we predicted it was going to sell for $15 per carton. The Costor was going to cost $7.20 to make, while the Limba was going to cost $8.25. And we know that our contribution margin is just our selling price minus our variable cost. So for the Costor, if we sold it at $12 and it cost us $7.20 to make it, we would have a contribution margin of $4.80 for each carton that we sold. And the unit contribution margin for the Limba would be $6.75. We budgeted to sell 130,000 cartons of Costor and 120,000 cartons of Limba, which means in total we are expecting to sell 250,000 cartons of our fruit drinks during this year. Let's compute our sales mix. We don't need it right now for the total contribution margin, but we're going to need these numbers later, so we might as well do it now. How do we figure out what our sales mix was, or our budgeted sales mix? Well, we simply take the amount of each individual product we plan to sell and divide it by the total number of units that we plan to sell. So for the Costor, we budgeted to sell 130,000 cartons. We also budgeted to sell 250,000 cartons overall. If we take 130,000 and divide it by 250,000, we come up with 52%. So we were budgeting that 52% of all of the products that we sold during the period were going to be cartons of Costor. Same math for the Limba. 120,000 divided by 250,000 gives us 48% of all of our products sold were going to be Limba cartons. And that accounts for all 100% of our sales. Now on to our total contribution margin. Well, we know our unit contribution margin, and we know the number of units that we're budgeting to sell, so we can figure out our total contribution margin from each product line by taking the unit margin and multiplying it by our budgeted quantity of sales. For the Costor, $4.80 per carton times 130,000 cartons should give us $624,000 in contribution margin. For the Limba, $6.75 of margin per each unit that we sell times the 120,000 units that we're planning to sell should give us a total contribution margin related to sales of Limba cartons of $810,000. And overall, we add those two numbers together, sales during the period should give us a total of $1,434,000 of contribution margin. So that was what we budgeted for. Now let's determine our actual contribution margin for 2017. We actually sold our Costor line for $12.50 per carton. We sold Limbas for $16 per carton. Our unit variable cost for Costor was actually $8 a carton. It cost us $8 to produce each one of these cartons. For the Limba, it was $7.75. Meaning that our actual contribution margin for each carton of Costor that we sold was $4.50, and for each carton of Limba that we sold was $8.25. Our actual sales. We sold 132,000 cartons of Costor, and we sold 108,000 cartons of Limba. So in total, we sold 240,000 cartons during the period. Well, what was our actual sales mix? Take the amount sold for each line, divide it by our total sales. It gives you the percentage of total sales that came from that line. Cost store, 132,000. Divided by the 240,000 units that we sold means that 55% of our sales came from cost store cartons. And using the same math, we'll have 45% of our sales come from the Limba cartons, and that accounts for all 100% of our sales. Figuring out our total contribution margin, take the unit contribution margin, multiply it by units sold. For a cost store, $4.50 per unit times 132,000 units means that the cost store contributed $594,000 towards paying our other costs. For the Limba, it contributed, by that same math, $891,000 towards paying our other costs. And in total, we had a contribution margin of $1,485,000. Now that we have all that information, we can compute our variances. So let's start with our sales volume variance. Formula for this is actual quantity sold minus budgeted units sold, so the difference in units between what you actually sold and what you plan to sell, times your budgeted contribution margin per unit. Start with the cost store. We actually sold 132,000 cartons of cost store, found in our actual table in the top right corner. Well, we budgeted to sell 130,000 from our budgeted table, which means we sold 2,000 more cartons of cost store than we thought we would at the beginning of the period. And if we multiply that by the budgeted contribution margin per unit, which is $4.80 from our budgeted table, we have a $9,600 variance, and it is favorable. Why is it favorable? Because we sold more units of that brand than we had budgeted for. More sales is always good, so we had a favorable sales volume variance. Our contribution margin increased from the actual number of units of cost store that we sold. Let's do the same thing for Limba. We actually sold 108,000 units of our Limba fruit drink. We budgeted to sell 120,000 units. And if we take that difference and multiply it by our budgeted contribution margin per unit, which was $6.75, we get a variance of 81,000, and this is massively unfavorable. Why? Because we sold 12,000 less cartons than we budgeted for at the beginning. So a lot of our missing contribution margin can be attributed to the fact that we didn't sell nearly as many Limba units as we planned on. And in total, the amount of variance in our contribution margin that can be attributed to this difference in sales volume, 71,400. Again, cost store is favorable. Limba is unfavorable, so it's the difference between the two numbers, and since the unfavorable variance is bigger than the favorable variance, the overall variance is unfavorable as well. We have a $71,400 unfavorable sales volume variance. So now let's move on to our sales quantity variance. And in this, we're going to start with the actual number of units that we sold overall. So the actual number of units that we sold was 240,000, but the actual total sales that we budgeted for was 250,000. Well, if we multiply that by our budgeted sales mix percentage for this particular product, 52% for the cost store, and we multiply it by our budgeted unit contribution margin, which was $4.80 for the cost store, we're going to come up with a sales quantity variance of $24,960 unfavorable. Why again is it unfavorable? Because we sold 10,000 less units than we had budgeted for at the beginning of the period. Limba, well, the actual total overall sales are still the same, so we're still accounting for this 10,000 less units that we sold than we planned on. Limba was supposed to be 48% of our sales mix and have a contribution margin of $6.75. So according to our budget, this decrease in sales volume of 10,000 can attribute to a $32,400 unfavorable variance for Limba. And in total, that is a $57,360 unfavorable variance. Let's move on to our sales mix variance. So for the sales mix variance, we're going to start with the actual total quantity sold. And we sold 240,000 cartons of our fruit drink during the period. From that, we are going to subtract the difference in sales mix percentage, which is attributable to that particular product line. So for CostStore, it actually ended up being 55% of our sales, but we budgeted for it to be 52%. So 3% more of our sales were in CostStore than we planned for. If we multiply that by the budgeted unit contribution margin of $4.80, we're going to come up with a sales mix variance of $34,560. And why is this favorable? Because we sold a higher percentage of CostStore in our mix than we budgeted for in the first place. For the Limba, we still sold 240,000 units in total, but the Limba was only actually 45% of our sales, where we budgeted for it to be 48%. So we sold 3% less Limba than we thought we were going to. Well, if we multiply that by our $675 budgeted unit contribution margin for this particular brand, we're going to come up with a sales mix variance of $48,600 unfavorable. And again, why is it unfavorable? Because Limba constituted a lower percentage of our sales mix than we budgeted for. So in total, that's going to be a $14,040 unfavorable variance, the difference between these two numbers, and it's unfavorable because the unfavorable variance for the Limba is greater than the favorable variance for the Costa. What does this all mean? Well, here we can see that our sales volume variance can be broken down in two things: our sales quantity variance and our sales mix variance. So we had a $71,400 sales volume variance, which was unfavorable. Why is that? It's because we sold less units. But we can break that down further. $57,360 of it, our sales quantity variance, can be attributed purely to the fact that we sold less units, while $14,040 can be attributed to the fact that our sales mix was not as good as we thought it was going to be. What do I mean by that? Well, the Limba in our budget had a higher contribution margin, so we're going to want to sell more of that product than we would the CostStore. But it didn't work out that way. We thought the Limba was going to be 48% of our sales. It was only 45%. So we didn't sell nearly as many units of our more profitable, if you will, product line than we thought we were going to. So of that overall $71,400 difference, we can attribute $14,000 roughly of it to the fact that our product mix was not what it should have been. We want to sell more of our more profitable units, and we did not.